Pulling along, if you see, this is our portfolio monitoring template, and what I've done is basically stock by stock for the portfolio. We have laid down our own analysis, tracking the quality of the portfolio, which is denoted by return on equity, and return on equity for this portfolio at an aggregate level is 20%. Uh, by and large in India, the cost of capital is 12-13%. So this portfolio with a very high return on equity means that the names in the portfolio are very, very high quality. And typically our debt to equity ratio is almost close to zero. So these businesses are not leveraged businesses. These business, as you see the names out here, are leadership names in whatever sectors, whatever areas they are operating. They would be in the top 1, 2, 3 leadership position, and all these companies are likely to demonstrate very high profit growth or very high earnings growth. At the aggregate level, we expect 26% earnings growth. So if this is one stock, then the profit of this stock is likely to double by 2024. And if again going back to stock prices are slaves of earnings, then that is the kind of return one should expect from this portfolio. Looking at the valuation, 3 year out FY24, the portfolio P multiple is at 15 times. So on one side, we have this perception that markets are expensive, valuations are looking very expensive, index is trading at 25 times, 27 times, 28 times. But on the other hand, active managers are managing their portfolios in a way that their portfolios are not as expensive as the markets are. So if you look at even on trailing basis, our 3 year price earning to growth is just about 1.2 times. And history has suggested that every time you have bought a portfolio or a stock at 1.2 price earning to growth, subsequently in the following 3 years, you have made a very, very strong outperformance in the portfolio. So, or in the stock. So in this portfolio, what you are seeing, if you just for the time being keep the performance of the last 3 years or 1 year on the sidelines, we know that there is underperformance. We accept there is underperformance, right? But we still have a portfolio which is delivering very good growth. It is very looking very reasonable in terms of the valuations. If you have to look forward, if you have to look with foresight and not hindsight, markets are always forward looking, right? Fund managers are also forward looking. So if you become forward looking, then this is what we are expecting. For example, this company called Kajaria Ceramics, number one company in tiles in India, very high market share of 25%, unorganized, clear beneficiary of GST, unorganized to organized theme. This company has done very well in the last 2 years, but at these levels also we expect the profits to double at 24% in 3 years time frame, available to you at just about 32 P multiple, right? So by no means this company is still very expensive, right? So you can go stock by stock. ICICI Securities, we expect a 22% growth. VIP Industries, which has been one of the worst impacted company in the travel sector because of the COVID, no travels. Now with travel coming back, holidays coming back, wedding seasons are in full swing, all hotels are booked. We expect a 2.4 times growth in the profits. The stock is available just at 28 times. So you can imagine some of these stocks can really be very, very steady compounding machines in the next 3 year time frame. I'm not giving you a very, very long outlook. Some of you may say that we have spent 3 years, 4 years, 5 years, but this is equities. You know, you have to remain invested in portfolios or in markets till such time you make money. Past has not been very good, but the future is looking extremely good. And these are backed by our numbers, what we have very transparently put up out here for you.